Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Master Profitability Ratios. Boost your financial analysis skills. Understanding a company's financial health is critical for making smart business decisions. Profitability ratios are one of the most effective tools for doing just that. They help you measure how well a business turns its resources into profit. Whether you're a business owner, investor, or student, knowing these ratios can give you an edge. In this video, you'll learn what profitability ratios are, why they matter, and how to use them effectively. What are profitability ratios? Profitability ratios are financial tools that measure a company's ability to generate profit compared to its revenue, assets, or equity. These ratios are crucial because they give stakeholders a clear picture of how efficiently a business is turning its resources into earnings. Whether you're planning an investment or managing finances, understanding profitability ratios is key to evaluating a company's performance. They're like the scorecards of financial success, simple to calculate, yet packed with insights. The role of profitability ratios in business. Profitability ratios aren't just numbers, they're decision-making tools. Investors rely on these metrics to gauge a company's financial strength before putting their money on the line. Think of them like a microscope, offering a closer look at whether a business can sustain and grow its profit. For management teams, these ratios guide strategy. They shine a light on what's working well and where improvements are needed. For example, if a company's profit margins are shrinking, it could signal rising costs or declining sales. On the other hand, an increasing return on equity might confirm that management is using shareholders' money wisely. Ultimately, these ratios empower both investors and leaders to make smarter, fact-based choices. Types of profitability ratios. Understanding the different types of profitability ratios is the first step to mastering them. Each ratio answers a specific question about a company's performance. Here are the most common ones. Gross profit margin. This tells you how much profit a company makes after covering the cost of goods sold. It's great for spotting trends in pricing or production efficiency. Operating profit margin. This shows profit after accounting for operating expenses, giving insight into how well the core business is managed. Net profit margin. A straightforward measure of how much money a company keeps from each dollar of revenue after all expenses. Return on assets, ROA. This ratio shows how well a company uses its assets to generate profit. Return on equity, ROE. This highlights the return investors are earning on their equity stakes. Each of these ratios tells a unique story. Combined, they create a full picture of a company's profitability and efficiency. Types of profitability ratios. When analyzing a company's financial health, profitability ratios provide powerful insights into its efficiency and success. These metrics help you understand how well a business converts its efforts into profit. Below, we'll break down the most common profitability ratios and what they reveal. Gross profit margin. The gross profit margin measures how much profit a company keeps after deducting the direct costs of producing its goods or services. To calculate it, divide gross profit by revenue, then multiply by 100. Formula. Gross profit divided by revenue times 100. For example, if a company earns $500,000 in revenue and has $300,000 in costs for goods sold, COGS, the gross profit margin would be 40%. This ratio shows how efficiently a company produces its goods and how much flexibility it has to manage other costs, such as marketing or admin expenses. A higher gross profit margin often indicates efficient production or strong pricing power. Operating profit margin. The operating profit margin goes a step deeper. It measures the percentage of revenue left after covering all operating expenses but before taxes and interest. The calculation is simple. Formula. Operating income divided by revenue times 100. Imagine a business earns $500,000 in revenue and has $100,000 in operating expenses. If operating income is $100,000, the margin would be 20%. This metric shows how effectively a company manages its day-to-day operations. A low operating profit margin might mean rising costs or poor expense management, while a higher margin signals strong operational control. Net profit margin. The net profit margin tells you how much of a company's revenue turns into actual profit after all costs, including taxes, interest, and operating expenses. Here's how you calculate it. Formula: net income divided by revenue, times 100. For instance, if a business has $80,000 in net income from $500,000 in revenue, the net profit margin is 16%. This ratio reflects overall profitability and efficiency. A low net profit margin could point to high expenses or poor financial management, while a high margin indicates strong cost control and profitability. Return on assets, ROA. Return on assets, ROA, measures how efficiently a company uses its assets to generate profit. It's calculated by dividing net income by total assets and multiplying by 100. Formula: net income divided by total assets, times 100. Say a company earns $50,000 in net income and owns $500,000 in total assets. The ROA would be 10%, showing that every dollar of assets generates 10 cents in profit. Companies with higher ROAs are generally more effective at using their resources, while a low ROA might point to underutilized or poorly performing assets. Return on equity, ROE. The return on equity, ROE, evaluates how well a company generates profits from shareholders' investments. It's calculated by dividing net income by shareholders' equity and multiplying by 100. Formula: net income divided by shareholder equity, times 100. For example, if a company earns $60,000 in net income and has $400,000 in shareholder equity, its ROE is 15%. This means investors earned 15 cents for every dollar they invested. A high ROE is often viewed positively, as it indicates efficient use of shareholder funds, but it's important to watch out for excessive debt propping up the number. Each profitability ratio gives a unique perspective on performance. When analyzed together, they offer a comprehensive view of how well a company is managing its costs, assets, and shareholder investments to generate profits. How to analyze profitability ratios. Analyzing profitability ratios isn't just about crunching numbers, it's about finding patterns and comparing performance. Whether you're benchmarking against others in the industry or spotting trends within a single company, these ratios can reveal what's going right and what needs improvement. Let's break this process down. Benchmarking against industry standards. Profitability ratios are most useful when you compare them to industry averages. Why? Because different industries have unique cost structures, market conditions, and competition levels. What looks like a healthy profit margin in one sector might be subpar in another. To start, identify the industry average for the ratio you're analyzing. For example, a net profit margin of 10% might be outstanding in a grocery retail business but weak for software companies. A return on equity, ROE, of 15% in manufacturing is decent but might lag behind expectations in the finance sector. Once you have industry benchmarks, compare them to the company's performance. Ask questions like: is the company outperforming its peers? Is it lagging behind? This comparison helps put the numbers into context. It can show whether a company is managing expenses better than its competitors or if it's struggling to maintain profits. Think of it like comparing the speed of a car in a race. Without knowing how fast the other cars are, you can't tell if a car is winning or falling behind. Trend analysis. Profitability ratios tell a much bigger story when viewed over time. A single year's data gives only a snapshot, it doesn't show you the direction the company is heading. But tracking ratios across multiple periods can uncover trends that indicate whether profitability is improving or declining. Here's how to approach trend analysis. Gather historical data for the profitability ratios you want to analyze. Aim for at least 3 to 5 years if possible. Look for patterns. Are margins steadily increasing? Is return on assets, ROA, dropping year after year? Find the reasons behind the numbers. Rising profit margins might mean better cost control or higher sales prices. A declining ROE could indicate poor investment decisions or higher debt levels. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.